I am sure that many watching have heard the advice that you should stay the course with your investments in volatile markets. But now that we are in the midst of this uncertainty surrounding the coronavirus, it becomes more challenging to follow that advice. Today, I hope to provide some sound reasoning to support why you should stay the course even now, and I hope that some of this information helps you feel more comfortable about your investments. As a disclaimer, what I'm sharing here is with respect to equity markets, and equity markets are volatile. Different individuals have different investment objectives and can tolerate varying degrees of equity risk in their portfolio. Although most people's objectives call for some degree of stock investment to provide long-term growth and help alleviate inflation risk. So what I am recommending is that individuals stay invested in equities to the degree that it is appropriate given their circumstances. If a certain degree of stock investment was appropriate before this period of uncertainty that we find ourselves in, that stock investment is equally appropriate today, despite the uncertainty. This presentation is brought to you by Covenant Trust. We provide investment management, trustee services, and estate and gift planning to individuals, families, and institutions around the country, and we are proud to partner with Covenant Living. My name is Drake Peterson. I'm a portfolio manager at Covenant Trust, and I'm pleased for the opportunity to speak with you today. So why would you want to stay invested in stocks today, despite so much pessimism and uncertainty? The first reason is that markets are forward-looking. By that, I mean that markets price based on investors' expectations of the future rather than what is happening in the present. This means markets can move in ways that contradict economic data and current headlines. This can explain a recent phenomenon where we saw an all-time record for jobless claims being filed, yet the market traded up. That is not intuitive, so it would be very challenging to predict and profit from. It is also extremely difficult to buy or sell a stock in advance of the changing expectations of the market. The market movement typically isn't backed up by the economic data you see or the headlines you read at the time, so many of the best times to invest rarely feel like the best times to invest. Investments in March of 2009, the market bottom during the financial crisis, appreciated over 400% before the exogenous shock of the coronavirus. In 2009, it didn't feel like a good time to invest, though. Continuing with that point, on this chart, unemployment rates during the financial crisis are charted in blue, referencing the left side of the chart. The S&P 500 index is charted in orange, referencing the right side of the chart. In this chart, you have the S&P 500 hitting its lowest monthly closing price on February 28, 2009. Data illustrating the peak unemployment rate didn't occur until next November, so an investor who waited for the uncertainty to pass would have missed out on a 45% gain in that time. And that's only if they knew that November was the peak. At that time, it would have been just as easy to think it would move higher, as unemployment had just skyrocketed to 10%. Data showing unemployment dropping consistently below 9.9% didn't occur until January of 2010. By that time, an investor would have missed out on a 74% return. So this demonstrates that the market typically moves up in advance of the widely available data improving. Similarly, here is the S&P 500 charted against mortgage delinquency rates. Delinquencies were important at the time because the financial crisis was driven in part by speculation in the housing market. Lower delinquencies would signify stabilization in that market. But looking at mortgage delinquency rates, they didn't peak until the first quarter of 2010. If you had somehow known at the time that 11.5% was the peak delinquency rate and reinvested in the market, you would have been waiting until May 31st, having foregone a 48% return in the meantime. A parallel of this idea today is that while we can't predict the future, we will probably see markets continue to trend upwards somewhat earlier than we see clear evidence of the coronavirus subsiding through declining numbers of active cases. This isn't a promise that markets don't decline to some degree prior to that because short-term moves and trends are difficult to predict. But we often have individuals asking about waiting for this uncertainty of the virus to pass before investing. And this illustration demonstrates that that is unlikely and will be costly in the long term. Like much of the economic data, the financial press is often focusing on the present rather than anticipating the future. In the aftermath of the great financial crisis of 2008 and 2009, negative headlines continued as the market continued to move higher. At the absolute market bottom in March of 2009, the Wall Street Journal was writing about how the market could go even lower. The financial press was largely negative through this period as the stock market moved 111% higher. Remember that the media is interested in your attention, and it is often easier to garner that attention with negativity when people are fearful about their financial futures. My second point is comparing the scale and timing of bull and bear markets. Reviewing the S&P 500's past from 1948 to 2019, we've experienced 13 bear markets. We have just had our 14th in March, which is not reflected here. Bear markets have typically lasted 13 months with an average cumulative loss of 25.8%, which we have already surpassed in March and are showing signs of possible recovery. Compare this to a longer 48 months for an average bull market that has a cumulative gain of 129%. As of today, April 22nd, we already find ourselves roughly 20% above the lows of March 23rd. The key takeaway is that we have recovered from every bear market historically, and they are often relatively quick compared to bull markets. Also note that bull markets can occur during an economic recession. In fact, 48% of bull markets do, again illustrating the point that markets can move out of step with the economy. The beginning of a bull market is difficult to predict. They are easy to miss in the transition by not being fully invested. My third point is that missing the best days in equity markets can have significant consequences. A relatively small number of trading days often make up a meaningful part of the market return over time. This chart demonstrates that missing the 10 best days over the past 15 years would have cost an investor around half of their return over time. Swift market recoveries also often follow soon after a decline. As markets become volatile, missing these critical days becomes more likely because the best and worst days are often clustered together. My final point is that markets have typically rewarded investors for staying invested. This is a type of compensation for taking risks when the outlook in markets is the most uncertain. The market's reaction to negative developments is often overdone due to fear and investors that have taken on too much risk. These investors are forced to sell at an inopportune time. All of this sets the stage for strong investment returns to follow steep declines for investors with discipline that are willing to take a long-term perspective. This chart shows the annual returns that have followed the largest one-day market declines going back to the 1940s. You can see that with 4 exceptions, these returns are positive and have averaged 18%. Illustrated another way, returns have been strong following a period of significant uncertainty. This chart shows the VIX index, also known as the market's fear gauge, on the left. On top, we have the S&P 500 return following a period where the fear gauge was within certain ranges. Looking at the bottom right of this table, you can see that investors have reaped the largest rewards over 12-month periods when they have invested amidst the most fear and uncertainty. And last month, in March, we hit an all-time high on this fear gauge measure. To conclude, the reasons to stay invested are markets are forward-looking and they begin to appreciate far before a turning point is reflected in most economic data and the financial media. Number 2, bear markets are generally short and relatively mild compared to the bull markets that typically follow. More than 48% of bull markets occur during recessions. It is better to stay invested to ensure participation in the bull markets and risk an intermittent bear market. Missing the 10 best days in the stock market drastically reduces your return over time. Divesting decreases your chance of capturing these critical days. After steep declines, markets have typically seen strong returns over the 12 months that follow, rewarding investors that had the resolve to stay invested amidst uncertainty. I will conclude by stating that equity markets are volatile, that is unavoidable, and investors must accept that. Despite the short-term market declines that can occur as a result, the general trend is and will continue to be upwards over the long term. That we now have well over a century of tremendous market appreciation reflects the ingenuity and fortitude of people and businesses to innovate and adapt to new realities. This continues to be true today, despite how uncertain present circumstances may seem. If you have any questions about the material reviewed today or questions on other topics, please feel free to reach out to us. We have representatives that work with families and institutions throughout the U.S. To find a representative near you, visit covenanttrust.com. Thank you. To view this presentation again or to share it with your friends, visit and subscribe to the Covenant Trust YouTube channel or follow us on Facebook at facebook.com/Covenant Trust Company. Thank you for watching.